Hello investors, my name is Gary Luna.
I'm Adam Carlini.
Grant Haddon is behind the camera and we are Dynamic Wealth Management. Today is Friday, June 3rd, and a good day to make a video. Some news that is potentially market moving, so we thought we'd bring it to you first. But it's been pretty hot here in Phoenix, hey Adam?
It has been. I mean, look at the trends here. Up to 114 today, tomorrow and Sunday, it's a real scorcher. We wanted to introduce to you a new pattern to correlation we found between weather and the markets. As you see the price moving up here, or the temperature moving up, we've decided that we want to be long markets on high temperature days. We expect the market might decline as weather does. That way you could cheer for higher prices or higher weather, higher temperatures.
Absolutely. We wish it was that easy. But we'll go ahead and give you some information on what's going on in the economy and stock market. So let's get at it. Folks, great to be with you on this Friday, June 3rd. Let's give you some information. First of all, a reminder that because of the summer months, we are taking a break as far as some of the formal events that we have, like our seminars and our investments for breakfast that we usually do every 2 weeks here in the office, and we're holding off, but we are still here in the office. So if you'd like to come by and see us, ask us more questions about what we do, some of the different models that we run, this is our phone number, and we'd love to talk to you and give you some more information. Let's go and jump into our risk indicator. Remember, this is just one of the models that we run, and this is a trend following model, which basically shows us that we are firmly in that green zone, and actually our clients have been rewarded over the last couple weeks as the markets have moved higher off of some support that Adam will talk in more detail about. But those that are new to this process, this means that we are more aggressive in the market when we are in the green zone. And as long as price action keeps moving our way, that means our clients are rewarded for that, at least for now. Let's go ahead and talk about the economy, a little bit of a mixed bag as to what is going on out there. This was the news that came out that we referred to in our opening. This is one of the main reports that comes out on a monthly basis, and it is the jobs creation report. And to cut to the chase for you, basically the markets were expecting about 155,000 brand new jobs being created in the month of May, and instead we only got 38,000. Not good at all. And in fact, as you look at the chart, historically that is not a good number. In fact, it was the smallest increase of jobs since the fall of 2010, which is not good. And so this was an article that came out from MarketWatch today, and to quote them, they're basically stating that raises doubts about the strength of the economy and possibly forces the Federal Reserve to scuttle plans to raise interest rates this summer. Right, that has been one of the focus points of the market for the next June meeting, which happens in 2 weeks, and the one that follows in July. So what does that mean? Well, quickly the markets reacted to it, and basically by the Fed's by the CME Group FedWatch tool that is available out there, there is only about a 4% chance of rate increases for the June 15th meeting, and that is drastically different from what we've seen just about 2 weeks ago. It was over 25, even 30% chance just a couple weeks ago. So with that information, basically the markets are anticipating that the Fed will have more room to hold off on interest rates, at least by the June 15th meeting. Now, Janet Yellen actually speaks on Monday, and I'm sure she will change that probability by the comments that she gives out to the marketplace. Other economic news, this is also coming from one of the Fed areas or members, and this comes specifically from the Bank of Atlanta Federal Reserve, and out on their website, which here is the address, they are basically, this tool forecasts on an ongoing basis what they believe GDP for the next quarter will look like. So right now they're forecasting a 2.5% increase in GDP, which is actually pretty good from where we've been. Remember, we were at 0.5, even 0.8 recently. So if we do come in at about 2.5, that would be an improvement on where we were for the first quarter. So that actually is positive if that continues to hold through. Another positive report that came out just a week ago, actually on May 31st, was the S&P Case-Shiller home price report, which basically tracks 20 cities across the nation, and it looks at the change on a monthly basis and yearly basis for the average home prices in those cities. And so here's the news: 19 of the 20 cities showed monthly gains and actually continue. Homes in general and the housing market continues to be a positive out there in the economy, even though it looks like jobs may be slowing. Hopefully housing continues, and as interest rates stay put and potentially even go down longer term, you would think that would be good for housing and for mortgage rates. At this point, I'll go ahead and turn things over to Adam, and we can see how the market reacted to this economic news that came out today.
So this is a chart, a 1-minute chart of the S&P 500 today. You can see that the market precipitously dropped right off the bat. In fact, to put it in Dow Jones Industrial Average terms, which more of you are probably familiar with, the market dropped about 150 points right out of the gate like that. And then the plunge protection team, so-called, seemed to step in, and the market kind of settled down and managed to rally back up, form a little bit of a base, rally up some more, although it did come back down near the end, but really rallied nicely off of where it was. And we'll show you a bigger chart to kind of see if we step back and see where that happens. So to look at it from here, you can see that today it came all the way down here, touched on that blue line, which is our 10-day exponential moving average, even broke through it a little bit, and then managed to move back up and finished not far off on a week. This is a weekly bar here. Managed to move back to where it was almost to where the market was last week. So really not a huge damage, although a hammer at the top of a move can also, the hammer candle can suggest a decline or a top in the market and a reversal. So we'll see if we're able to move forward. Positive news is, in the past, we had this shoulder, head, and shoulder, and it looked like right here we were going to go down, but the 200-day saved us, and it rallied back up and managed to almost get to new highs. You can see that we almost closed at new highs, but still we're not there yet. 2132 was the figure back in May. Or that was in July. Actually, it was a little higher than that back in May. But you can see that it's been on a decline, and then it managed to really come close here. So we're pushing right at the edges here. If this market manages to break through this, see, draw back here a downtrending line to those peaks. If it manages to break through here, then it's got room to go. So we're really at a critical juncture, and it did test the lower limit on a weekly basis today. So it'll be interesting to see, or a daily basis rather. That's a single day. This was yesterday's day. So it looks positive from that standpoint that it could continue with this move forward despite the terrible news really on the jobs market that came out today. So looking at it from taking a little further step back and looking at it on a weekly chart, you can see we had this nice channel where the market was trending upwards. It kind of flattened out, and we've been in this declining channel until it managed to break above it, and then it's been riding the line down until this last week when we had a big up move. The fact that even though we came down, that we didn't give away that last move, we actually moved up slightly more this week, that's actually a positive despite the news today. But today's news, that was pretty big news, and we're going to need to see how the market digests it. It did do a pretty good job digesting it today, though. So looking forward or looking at the actual breakdown of different sectors or different areas of the market, U.S. stocks positive now year to date, up 3.68%. International markets basically flat for the year. Emerging markets are up. Real estate is up. High yield bonds, which had been, real estate, emerging markets, high yield bonds, commodities, gold, all of these things were not doing so hot not that long ago. In fact, I'll show you another chart and you can see that. Treasuries and long-term treasuries, those short-term and long-term treasuries, all both positive. Gold actually has pulled back about 8% from where it was. It actually had gone up even more than this. But really an interesting move here. This move here is based on the declining interest rates that we have been seeing, which weakens the dollar. A weaker dollar is good for commodities and gold. Today's news was that, with the weaker job report, suggests that interest rates, as Gary went over, are not likely to increase in June, maybe not even in July. We'll see. And if they don't go up in June and July, lower interest rates means a weaker dollar, which means a continuation of this move in commodities and gold. So it'll be interesting to see how that works. So we're really in a risk-off move right now as we got to the top of the market range and things have started to head back down. Today, utilities did very, very well. Staples did well. And, fortunately, the Staples is one of the things that we're holding in, is one of the sectors we're holding in our ETF core model. So just to show you what things looked like not that long ago, okay, I didn't put the names on here, but this is, there's your commodities and your high yield bonds and your gold. These were all negative back at the end of the year. From July 30th to the end of the year, those were sharply negative, commodities and gold. And why? Well, because we had a strengthening dollar. Then we got a weakening dollar. Now, what are we going to get? It'll be interesting to see. The dollar had actually strengthened a little bit on the news of a potential rate rise, and now it's turned back negative and begun to go that direction again. The strength here, though, is you'll notice the treasuries. So the short-term and long-term treasuries, even a few months back, they weren't bad. And notice REITs. So those are your strong areas. They were strong from July to December. And if we go back here, you'll see REITs and the treasuries really boomed this year to date, as a risk off. So risk off, even though the market's moved up slightly, there's been better strength in the risk off assets and the defensive assets that do well in a weaker dollar environment. So a very interesting environment that we're faced with right now. High yield bonds bounced back because a lot of the damage there was done by oil, which is part of the commodity complex, which benefited now from a weaker dollar, and the expectation that the dollar may be weaker with a deferral of a rise in interest rates. So now looking at our model allocations, how are they affected by all this? Well, the model is still above the yellow line, so we're still fully in the green zone, bullish zone, as Gary had mentioned earlier. And today, we had a good day, actually. It was a negative day in the market, but a positive day for our core ETF model and many of our other models because of where they're allocated within the market. The core ETF model is holding a fair amount in bonds, midterm and short-term treasuries, which actually rallied nicely today, more than the decline in stocks. And as I mentioned earlier, staples also have picked up. Consumer staples were up today nicely. And even though technology was off, it wasn't down as much as the market. So we've got we've held up nicely after digesting this big rise from last week. So we're still in the bullish territory. Again, it'll be interesting to see how things play out this coming week. We get to hear from Janet Yellen on Monday. Probably going to try and save face after they've talked about raising interest rates and now seeing this terrible jobs report that doesn't support a stronger economy. There are ways to spin it to make it look stronger, and I expect that's what we'll hear on Monday. And so we'll see how that affects the market. Maybe that would strengthen the dollar and reverse the gold down a bit. We'll see. So that's where we're at right now, which means that we are in the green zone. So for our growth model, anyone in the growth ETF core model is 100% risk on, so in aggressive assets, market assets, equity assets. Moderate model is 80% equity, 20% defensive, which is the treasuries. And the conservative model is 60-40 right now, 60% in equities, 40% in the defensive. We've got about a 4% cushion before we would break into the neutral zone. And so, again, if that happens, we get you out of harm's way before it becomes very ugly and reduce that exposure. Here's our disclosures, and we thank you for your interest in our videos. We look forward to talking with you as more developments occur in the weeks to come.